So next we have to case law on capital expenditure. So number one is in capital expenditure we know that it is not allowed as expense but it is capitalized as the cost of asset. So number one case is Honda CL cars versus CIT 2017. So in this case what happens is technical fee is paid for setting up a joint venture company. It means a new company is set up and for this purpose technical fee is paid. So, and why this fee is paid? So this technical fee is paid to use the technical know-how for a limited period for setting up a new business. So it means when technical fees is paid for setting up a new business, it will be treated as capital expenditure. So it means on this technical know-how, it will be treated as intangible asset. So it is intangible asset on which you can claim depreciation. And the rate of depreciation is 25%. And the case law, so Neston Technical Services versus CIT 2013. So in this case, the company has issued shares, so expenses are incurred on issue of shares which are called public issue expenses. But money, application money was not received properly, so public issue was cancelled by SEBI later on. So question is whether issue expenses are revenue or capital nature. So it will be treated as of capital nature because it is related to issue of share capital which is of capital nature. So you can treat it as preliminary expenses under section 35B and the deduction allowed is 1/5. So it is not revenue expense. Another case law, Bharat Gears versus CIT 2011. So in this case, the machine was broken down so many years ago, maybe 5 years ago. But in current year, so it is repaired and reconditioned so that it can function smoothly in future. So what happens, whether it is revenue expense or capital expense, since this machine was already broken down, so it brings into existence a new plant and machinery and for future benefit. It means when you are doing reconditioning, it will bring a new plant and machinery similar to new plant and it will provide a benefit in future. So this will be capitalized and you can claim a depreciation. So this is not revenue expense. So another area, CIT versus Motor Industries 2011. So in this case, one building is demolished and reconstructed. And this is normally a cell room where our computers, or we can say that IT hardware and software is installed. So which provides IT services. So this room is completely demolished and re-erected. So whether it is revenue expense, so it will get a new asset is created after demolition. It means whenever there is a demolition, so our old structure will be demolished and a new structure will be created. So which is a new asset, so it is a capital expenditure and you can claim depreciation. Like if it is case of building, so you can claim depreciation, rate of depreciation of building is 10%. So another case law is CIT versus Shape, so Mangyar Karshi Mills 2009. So in this case, several machines are integrated to produce yarn, means cloth. Like in process costing, you know that there are different machines and product passing from machine A to B to C to D, and one of the machine is broken down and this is replaced. So one of the machine is replaced. So whether it is revenue expense or capital expenditure. So since full machine is replaced, it will be treated as a capital expenditure and not revenue expense. And you can claim on this capital expenditure depreciation you can claim. The next case law on capital expenditure is CIT versus Remaining Engineering and Industries Limited. So in this case, so security deposit is given to landlord who get a premises on rent. But the landlord is not returning this security deposit. It has become non-recovery of security deposit. It means it has become bad. So whether it is our capital loss or business loss. So since the security deposit is refundable, but it has become bad, but it is not in the nature of a rent. So it will be treated as capital loss, not business loss. Because its nature is not a rent, it has to be recovered later on. But now it has become that, so it is capital loss. So next graph, Ravindra Laboratories versus CIT 1994. So in this case, feasibility study was conducted, means expenditure is incurred on feasibility study for a new project. Later on, this new project is abandoned, means failure. So last time we have seen that when we conduct a feasibility study for existing project or extension of existing business, then it is allowed as revenue expense, but here it is capital expenditure. Because this is for a new project, so it will be capitalized. It is not business expense. So we can say that not allowed as business expense. So another one is Swadeshi Cotton Mills versus CIT 1967. So here compensation is paid for breach of contract of capital asset. Means we have to purchase capital asset, but its contract is cancelled and we have to pay some compensation. So that is this is revenue expense or capital. So it is also capital nature because it is related to purchase of capital asset. So it is not allowed as expense of business. Another one case law is Punjab State Industrial Development Corporation Limited PSIBC versus CIT 1997. So here expenses are incurred for alteration of memorandum of association, objectively to increase authorized capital. So since it is related with our increase of share capital, authorized capital, so it is also capital expenditure. So it is not allowed as a business expense. So you can download PDF, so all these case laws are given.